All right, here we are with Adam, the CEO of VistaShares. Adam, can you give us a little bit of history about your background?
Yeah, I've been in the ETF market since, believe it or not, '01. I launched an ETF with State Street back in '01 called the Fortune 500 ETF. I was running Fortune indexes at Time Warner. Fast forward, I started a company in '06 called Index IQ. We were the first ETF firm to bring out liquid alternatives. Built that up, sold that to New York Life in 2015 and spent a few years there rolling out their global ETF platform. And then I left and started VistaShares actually a year ago yesterday.
Oh wow, okay. So what hold on. Go back to 2001. Were these income ETFs?
No, no, no. Yeah, the Fortune 500. So I was running an indexing group at Time Warner for Fortune magazine. So
Okay.
Fortune magazine has the Fortune 500. It's a list they publish. So we developed an index based on the Fortune 500, which is basically the Fortune 500, 500 companies, but top companies by revenue.
Yeah.
And we launched an ETF. It was a triple F, it was the ticker. And so we launched that back in '01, and it doesn't exist anymore. And then in '06, Index IQ was focused on liquid alts. So we did hedge fund replication strategies, kind of institutional quality strategies that we embedded into the ETF structure to bring kind of hedge fund like low volatility solutions to a broader market.
Interesting. Okay. Now were you guys doing, I assume you were buying the S&P, but because you can only have 25%, what were you doing to get that extra, that extra leverage?
In what, the replication strategies or
Yes. Yeah, yeah.
oh yeah, hedge fund replication was totally different. So yeah, so what we did there is, so if you look at hedge fund returns over time, there's certain,
Massive recently.
well, over time, you look over time. So, different strategies perform differently in different markets. So what you do, if you run a quantitative process, you can identify the factor exposures that are driving those return profiles.
Mhm.
The return profiles are all run by the same factor loading. So it's equities, it's fixed income, it's currencies, it's commodities, it's cash.
Sure.
So if you can identify how those returns are being constructed by applying these factor loadings to the historical data, you could actually replicate with a pretty good certainty the hedge fund style over time. And that's what we were doing. So it was basically an ETF of ETF. So we would have, our ETF was comprised of, we did have the S&P, we would have, emerging markets and EFA and all the different slices of equity. We'd have all the slices of fixed income, the currencies, the commodities, the cash, and those would adjust monthly based on what the hedge funds were doing in the market. A pretty
Interesting.
sophisticated
Okay.
strategy, yeah. So it was early. We did really well with that. So we built that company up to about 5 billion in assets, and so it was fun, a lot of fun.
Now this, just because I recently stumbled upon this, is this like an kind of like an ETF in a box where you sell like an idea to a holding company or a compliance office and they kind of do the back end work and they kind of help you launch your fund?
The current company, VistaShares.
Yeah, Vista shares are the previous ones.
Well, the previous, no, well, Fortune Indexes was an indexing operation. So we just worked with State Street. State Street launched the
Yeah.
ETF.
Okay.
So we were, that's how we did that. Index IQ, we built all the infrastructure. We had our own trust, we had our own trading desk, we had all that built in.
Yeah.
So we built all that infrastructure out, and because that's what you had to do back then. You had to build all the infrastructure and launch a fund company.
Mhm.
With the Vista shares, we're working with a company called Title Financial. So
Mhm.
Title provides us the infrastructure, so we don't have to build it ourselves. So we use their trading capabilities and their fund administration, their compliance, and that's what they do for a living. They're the largest kind of, I guess, what you call white label ETF issuer. So they work with companies like us to construct the products. We manage the products along with them, and they're our brand. We do all the sales and marketing. So there are products, but we use their infrastructure.
And who's the transfer agent?
The transfer agent. Well,
Yeah.
we use all of their infrastructure. So U.S. Bank is the main custodian.
Okay.
Yeah, so that's so it's basically all the biggest players. They have 32 billion in assets. So they have a lot of infrastructure there.
Yeah, I'm familiar with Title. I didn't see it on the website anywhere. So, and I was, I was going through and I'm like, I can't find the transfer agent, so I figured I'd ask.
Yeah, no, it's a great question because the title's behind the scenes. They're kind of the operational partner.
Yeah.
They do a great job. I can't say enough about those guys.
Well, with that being said, Adam, if there's any question that you can't answer because of compliance, I totally understand. I don't want to put you in like a weird spot, but
Oh, I
I
appreciate
do
it.
get it. People think that like you get the CEO and he has to know everything about everything, and there's certain things like you can't divulge. So I get it, but I just want to make that clear to the
I
audience.
appreciate it. I appreciate it.
Well, let's get into it. You have, as far as I can see, you guys have two current ETFs. The first one is AIS, Artificial Intelligence Supercycle. It's an AI play on data centers, 10 million in assets, expense ratios, 3/4 of a point. Distribution is semi-annual. 48% of holdings are in semiconductors. I got a question. Is there any interest in the quantum? That's been huge this year.
Yeah, quantum. Well, that's a whole different play. And yeah, I mean, it's a great place. We don't play in that sector currently. So the AIS is a pure play on AI infrastructure. So
But
if you look at all the funds in the marketplace, or most of the funds, I mean, yeah, I'm sure that maybe someone could find an exception, but generally what their exposure is the Mag 7. Right. They're really focused on the hyperscalers. So you look under the hood, you've got Meta, you got Google, you got Apple, you got Amazon. That's like the most of your exposure. But most investors have exposure to those companies. So
Mhm.
it's not the best way to play AI. The way we play AI is by digging into the supply chain to determine exactly what goes into building the AI infrastructure. So when you see all this news about hundreds of billions of dollars in capex being deployed by these companies or Trump with his $500 billion Stargate program, and when you hear about that, where's that money going? It's going into infrastructure because you need to build the infrastructure so that the large language models can then become more powerful and add more value to the end consumer. So we're not focused on the end consumer. The infrastructure is comprised of data centers and semiconductors. So what we do is we dig into the supply chains there and we overlay the bill of materials, meaning, we look at a AI data center. What does it cost to build an AI data center? What components go into it? And that's what we do. So we do all that research and we find the companies, we look at their financials, determine how much AI revenue they're getting. And if they meet our thresholds, they go into the portfolio. So this methodology, which is completely unique, we filed a patent on it. Is nothing like it in the market. It was developed by my partner, this guy, John McNeil, who is the president of Tesla. And he was the COO of Lyft, and he's on the board of General Motors. He's a brilliant, brilliant guy.
Wow.
So he was trying to find ways to invest in AI, and he couldn't find a good way to do it. He said, "There's got to be a better way." And this is why when he came up with this bill of materials concept of really dissecting the supply chain to find the kind of the hidden gems around the world, the cooling companies, the racks, the fiber optic cable, those are the companies where all this money is going into now. That's who's making the money in AI right now. So until all the infrastructure is built out to the point where these large language models can be extremely powerful and provide the value that the Apples and the Googles and the Metas want, that the money is going to be made in the infrastructure, and that's what AIS is.
So it's not the painting for gold, it's the selling the shovels metaphor.
Picks and shovels, exactly, exactly. Perfect analogy.
Cool. So it's you get data centers, you have to have some sort of like, how are we going to power these, right? Electricity, or I know coal's kind of making its way back around because it's pretty efficient, it's cheap. And then you have any exposure to like Terra Energy. I know Bill Gates is making those mini nuclear reactors with salt.
Yeah, that's really interesting. So we do not have energy producers in this product by design.
Mhm.
We have another product, an electrification ETF that we're going to be bringing out that will have all of those components in there as a pure play. So all we're focused on here in this AIS product is the supply chain to build data centers and the supply chain to build semiconductors. All those companies that build those components that go into the infrastructure for AI.
And what's the yield on that?
Well, we haven't paid it yet, so I couldn't even speak to that yet.
So I was gonna. The only reason I asked is because I was looking at the website and I'm like, I can't. There's nothing on here for like distribution. There's no yield.
Yeah.
Um, is there any? Are you? How do I explain this? Are you guys going to go for like total return at the end of the year, or are you going to try to print out as much yield as possible? And
Yeah, AIS is not designed for yield. It's not a yield play. There will be yield, but
yep.
I don't know what it will be. So I'd rather not, because I'll be wrong and I'll disappoint people and they'll be angry with me. So I don't want to speculate what it'll be, but it's really a growth play. It's a
Okay.
equity growth play,
Yep.
with some type of payout. Now there are quite a few industrial plays in the portfolio, so I guess we'll have a decent yield. But it's there's 80 companies in the portfolio, so it's hard for me to really identify what that might look like.
Yeah, just because the a lot of viewers, like I have one side of an audience who's really into, you know, dividends, but like at 10-12%, but they want a little bit of upside growth, maybe 6.
Mhm.
But then there's the other side that are looking at like closed-end funds or limited partnerships that are just going, I don't care what happens to the NAV. I know that the price is falling, but I'm getting a massive dividend every year. So I was trying to figure out, and that's typical in the commodities sector is, you're going to get a nice cash dividend, but over time, it just kind of slowly erodes.
Yeah, that's true. So yeah, so AIS will just be, it's a growth play. It's a long-term holding. If you believe in AI, you want exposure to AI, this is the best way, in my opinion, to get exposure because you're getting exposure to the actual infrastructure, not the Mag 7. If you want Mag 7, you probably already own it. Most people have Apple and Google and all those in their portfolio, or in one of a dozen other funds they may hold. You don't need it again. And frankly, those are not AI companies. They are companies investing in AI at this point to develop those consumer-facing applications to, create value down the road. But we're years away from that. So, AIS is a very unique play. And we launched it in December. We didn't start really even marketing it until January. And then, of course, the market's been rocky, but we've grown really nicely. And, we anticipate that to be a big winner for us. And then on the income side, we've got, of course, the other product that, is newer and really proud of that one.
We'll get to that one in a second. You mentioned, but before I move on, is there anything in there that has military application? I think it was General Dynamics just pushed out a product that's going to involve AI, and basically they can change. I think they can change shape of like their actual aircrafts. Their unmanned aircrafts will change shape in air. It's wild.
That's crazy. Yeah, I mean, look, all of the companies in this portfolio are building the infrastructure required for AI use. So
Okay.
whether it's consumer use or, commercial or defense related, these are the companies that are the most important in building that infrastructure. So, I don't know that we have a portfolio company that is coming out with something like that as an end product, but the cooling systems, the Vertivs of the world that are in our portfolio, they're the largest player in cooling systems for AI data centers. So whether it's a defense contractor or a consumer or commercial, data center, that product is going to be used. So it's a way to play the whole landscape.
How does that cooling work? Do you know? I've never heard of this.
Oh, well, I mean, to cool off these servers, to cool off the facilities, these I don't know. I think it was Sam Altman came out the other day. He came out with a joke. He's like, "Stop creating images on ChatGPT. You're burning our servers." But the servers heat up from use. I mean, it's very hot,
Yep.
and you need these massive cooling infrastructure to cool down the components and cool down the facilities. And it's not just air conditioning, it's piping and it's all this different, and that's beyond my scope in terms of knowledge on how it's all configured. But yeah, it's a critical piece. In fact, interestingly, as part of our analysis, so we've created this supply chain analysis, and cooling systems, believe it or not, is 30% of the cost of an AI data center.
Wow.
Yes, so it's literally the biggest piece. So yeah, and those are companies that most investors don't have exposure to, probably because they're, who would think?
Are those publicly traded?
Yeah, they're all publicly traded.
I'll have to do some research on that. It didn't even occur to me that that was such a, but you're right. I mean, it's such a big infrastructure part of it.
Yeah, I could send you after the call. I could send you a one-sheeter that shows you how we break down the supply chain on semiconductors and on the data centers, and then how the companies map. So we do the supply chain analysis. We overlay the bill of materials. So
So,
the supply chain, and then we say, okay, well, how much is cooling systems? How much is racking? How much is fiber optic cable? And then we find the companies. We map the companies to each segment, and then we dig into their financials to determine how much revenue they're actually getting from AI projects. Because just because a company's in the cooling business, even if they're in the data center cooling business, doesn't mean they're getting AI data center business. So that's really what we try to provide as a value for this product, to really dig in.
and these are actively managed funds, is that correct?
Exactly. So that product, so we have an investment committee that sits, so the core of our portfolio is 100% rules based. So it's a rules based process. The rules are published. It's transparent. So you can know exactly why a specific company is getting into the portfolio. But in fast moving industries like AI, you really need people with knowledge to oversee the portfolio to determine, what's going on, right? To find those risks and those opportunities as they happen. So our investment committee, we're very fortunate to have a great investment committee over AIS. We have so John McNeil, I mentioned, who is my partner. We have this guy Sunny Madra, who is the president of a company called Grok, GROQ, which is one of the leading AI companies in the world.
Like a
Uh,
play on words.
yeah. So yeah, so he's the president of that. He's been in the AI business forever. Um, and then we have a professor who is the former dean of NYU Stern School of Business, and he was the chairman of the finance department there. And then myself. So John and Sonny's job is to identify those risks and opportunities, because they know the industry globally so well. And then once they find those opportunities or risks, then it comes over to Professor Whitelaw and myself to restructure the portfolio as necessary to incorporate or pull out securities as needed.
Okay, so are you trading, or is it more like a Vanguard where you're just kind of recycling and seeing where earnings are?
Well, we'll trade when necessary, sure. If we need
Yeah.
to add a portfolio or add a company to the portfolio or take one out, sure. That's, absolutely. I mean, we
There's not
won't
a massive turnover.
No, we're not going to be doing that. So we're not going to be waking up in the morning and say, wait a minute, let's trade these 3 securities and sell these 5 securities. No, it's really, the portfolio is sound as it is. It's really more about finding, wow, this company, our portfolio just lost a massive project in Saudi Arabia. So they no longer meet our criteria. And this is an example. I'm making it up. They need to probably come out of the portfolio, or there's a new company that just popped up in South Korea that is now owning the racking business for AI data centers. They weren't in it before, now they are. We need to get them in the portfolio. Those type of things.
Makes sense. I want to move on to is there anything else you want to touch on with that? With AI?
No. I mean, I love that product. It's and it's on sale. I mean, everything in the AI
Everything.
business has come down, which is good because there was a lot of froth.
Yeah.
So, it's I mean, for me, it's a good entry point. I like buying low.
I don't understand the idea of buying when everything's green. It just I like Black Friday shopping for for assets.
100% right. You nailed it. That's exactly right. Go where they ain't, right? When
I
the
think
feet,
it's something deep inside, right? It's like that internal fear, like you could be making the wrong choice. Why would you buy when there's so much like anxiety built up, and you're like, this doesn't feel right, but like I know I have to, like mathematically it makes sense.
yeah, I mean, because plus, well, I mean, as long as the underlying dynamics of the portfolio haven't changed. So is AI any less attractive today than it was 2 months ago? No. I mean, these hundreds of billions of dollars are going into the industry. The money is being deployed. It's a strategic directive from countries around the world to own AI. It's an arms race. So, sentiment it's negative sentiment now. It's a risk off environment, but that's usually, to your point, probably a smarter way. You're never going to bottom ticket. At least I can't. I'm unable to do that. But when things come down 20-30%, if you liked it then, it's probably more attractive now, as long as the dynamics haven't changed.
Definitely. OMAH. So that's actually how I came across your company. Berkshire Select Income. It's got 21 holdings. Again, I wasn't able to find the distribution. It looks like it's paying monthly
Yep.
dividends. Can you talk about this? What is this fund comprised of?
Yeah, so we paid our first dividend late last week on the 28th, and we are paying monthly. So what this is, it's a very simple product. So the equity component of the portfolio is 21 companies. The top holding is BRKB,
Okay.
Berkshire,
Yep.
and the next 20 holdings are the top 20 holdings of Berkshire Hathaway. So we dig into their 13 Fs, determine what are their top holdings, and then we buy those top 20 holdings in, the right proportions based on how they own them in their portfolio. So that's the portfolio. It's a very simple, it's a core equity portfolio. You've got Apple, you've got Bank of America and Verisign and Visa and, MasterCard, big companies, big blue chip companies, which is what Berkshire generally owns. And it's a nice core holding. And then what we do is we run an active process or an options overlay over the portfolio on the individual holdings. So we're not using index options. We're using options on the individual companies. And the goal is to generate 15% annually or 1.25% per month. And that's what we did in our first month, 1.25. It paid out 0.25025 cents
Okay.
on the portfolio.
Can you talk? So this isn't. So you're not running like a covered call strategy on Berkshire. You're trading options on the underliers that Berkshire has.
As well as Berkshire. So we're selling calls or
Okay.
call spreads, depending.
Yep.
And we're doing that on all 21 of the equity holdings. So we have, what we call full coverage on the portfolio. And so Berkshire Hathaway is one holding, and then the top 20 holdings of Berkshire are the other 20 holdings. So we're selling calls, out of the money calls on those holdings.
How far out of the money?
Well, that's a great question. I was going back and forth with an investor yesterday about that. It depends on the intrinsic value of or the implied volatility. I'm sorry, the volatility of the holdings. So we're doing shorter term trades, but how out of the money they are depends on the volatility of the securities.
How many days to expiration?
I can't answer that exactly
Okay.
because
I understand.
and it's not a secret. It's just I don't want to give you wrong information off the top of my head. All of the options holdings are on our website. So
Mhm.
while there are 21 holdings, equity holdings, all of the option holdings are listed on our website as well. We have a file that you can just download. Boom, you have every single one of the whole holdings.
Okay. So I've had a bunch of different fund managers on the channel. It seems to be that 0 days to expiration is probably the most popular, but I would say the most successful I've come across was Howard Chan's from Curve Invest. He's doing, I think it's 15% out of the money, whereas a lot of ETF players are like 5% out of the money. And just because you can't capture like that, there's like a sweet spot in there. I don't know. Dude, what do you think is the sweet spot?
Honestly, I don't know the answer to that because it, it's it's probably outside of the scope of my expertise to really provide that information. I could, speculate, but I don't know. I don't
You
know.
asked for hard questions, Adam. I
Yeah,
told
no,
you.
this is a great it's a great question. I want you to stump me because I don't need softballs. But if I can't answer it, I'm not going to BS you either. I just want to be honest. So if I don't know the answer to that.
That's okay. Not a problem. So 15% annual dividend. Are we aiming to over distribute? Do we want some potential upside growth? What is the
Oh yeah, we're
goal?
looking for both. We're looking for both. So we want the portfolio to grow for sure. So we're probably looking at like 70 to 75% upside capture on Berkshire Hathaway.
Okay.
And along with then the 15%, overlay as well. So, the NAV erosion is going to be minimal. I mean, you saw it, well, you didn't see it because you probably weren't watching it, but, we paid out the quarter and, the NAV erosion was,
It's,
basically.
it's recovering the NAV.
Oh yeah. Yeah.
That's what
So,
we want.
Yeah, so you're not going to see the NAV erosion that you see with some of these massive dividend plays that, we're not looking to do that. We're not giving you, we're not looking to exceed the 15% either. We're not trying to knock it out of the park. We want to provide what we're saying we're going to provide, consistently.
There's definitely been in the past 18 to 24 months a huge cycle where everyone was in, including myself. I'm not, I'm not. I was definitely involved in this, where you get this kind of hopium that these 100% dividends in 1 year are going to last to infinity, and all of a sudden you have this infinite money calculator,
Yeah.
and then you start looking at it, and I'm like, you're losing money faster than ever, then you could possibly contribute. And dollar cost averaging is a mathematical fallacy. Like, you cannot chase the NAV down. You can't throw good money after bad. And so I think there's a huge rotation of people moving out of those funds into things that either trade sideways and up, or just slightly sideways, or maybe slightly, but the dividends are consistent. They're 10, 12, 15%. And it's like hammering on the door. People are really kind of cycling into that and going, we got to protect ourselves, especially in this environment where everything's just collapsing.
I mean, it's smart. I mean, look, I'm a portfolio construction guy. I'm not a trader. So everything you said, I would agree with 100%. I think it's about finding the right tools to provide you the right outcome in your portfolio. So, yeah, if you want to take a shot at some of those, big dividend plays, I wouldn't make it a core of your portfolio, or at least I wouldn't. I think something like this, and there's other, broader plays as well out there that provide that 10, 12, 15% that are better core equity holdings. For us, we have kind of two distinct use cases for this product. It's a core equity holding. It's going to give you the upside, or most of the upside, I should say, along with, the nice steady dividend. So you can use it as a core equity holding, or if you own Berkshire Hathaway doesn't pay a dividend. So you could carve off a small piece of that, use Omaha as part of that, your allocation, to create kind of a synthetic dividend on your BRKB holdings. I think that's kind of a nice, elegant solution for using this product.
Do you guys have anything in this particular ETF that is like a protection against downside risk?
It's not a stated goal, just as part of the option strategy. There is a little bit of that, but I would not overstate that. So, I think we're still looking at kind of 85, 90% of the downside. So, hopefully you're not getting 100% of the downside, but it's not the goal of the product, but that's just kind of the byproduct of the strategy. So
Okay.
it's not a buffer product.
How? No, I just didn't know if I don't know, maybe you allocate 10% of the funds under management towards like a commodities play, just to give it a little bit of buffer
No,
at the
no,
bottom.
we don't do that as part of the strategy.
Okay. I know you guys you just started this fund, correct?
We launched it on March 4th.
Okay, so you haven't even issued a 19A yet.
No, no, I was actually following up yesterday about that, when that's going to be. So we don't have that yet. No.
For anyone who's watching, a 19A is just like, are these going to be ordinary income? Is it going to be return of capital? That's kind of been like the talk in the scene, because a lot of people don't know what that is. Can you?
Yep. We anticipate this to be a return of capital. That's how it's designed, and that's what we're stated. That's the stated goal.
That is the stated goal. Okay.
Yes.
And are you able to? Do you get the same tax advantages as like? I know you get benefits if you're in one of the indices.
Yes.
Yeah.
There's something else that I'm not fully, you're probably much more expert on this, 1237 or something like that. Yeah, these are not index options. We have the ability to use index options if we need to. For instance, if we can't find the right combination of options on the underlying securities, but we're not using those as a kind of a main strategy. So that's a whole different tax regime that I'm not 100% familiar with myself from a tax perspective. But return of capital generally is preferential in lieu of that, because you're deferring any tax consequences on the distributions and the distribution until you sell, and the distributions are then being netted out of your basis when you sell as well. So you're getting that tax benefit.
Yeah, you get the step up in cost basis.
Mhm.
which that's, a subject for a different video. Um, the excess holdings, are you guys deploying all of your capital, or do you have a slush fund on hand that's like buying up, 4.5% treasuries? Like, what do you do with excess capital?
There's excess cash in there that would be in a, in some type of, cash instrument. But it's really more about, it's not a part of the strategy to hold cash. It's more about, for instance, when creation units come in.
Mhm.
Are we able to deploy all that cash immediately, or is a 1 or 2 day lag before that can be deployed? And if it's not deployed, then it's in a cash instrument, providing some type of return. But again, it's not something I would state as a part of the strategy or a selling point of the strategy. That's not what we're trying to achieve.
Okay. I know that's been there's a couple, other funds who have used that strategy just to squeak out maybe an extra 0.5%.
Mhm.
You know, it's a nice play.
Yeah, yeah, no, it's great. I mean, absolutely. So I think again, we're using it as a byproduct of the strategy. But again, I mean, as we talk and as you get to know me, you'll see I try to, I'm very conservative in what I say, and I just don't want to over promise and under deliver. And so, I'm just very straight on that stuff. So it's not a stated part of the strategy. It's a byproduct of the of running the strategy, perhaps. But I wouldn't use it as a selling point.
And how are you mitigating against NAV erosion? Just not over distributing? What do
Yeah,
you
exactly. Exactly. We're not looking to distribute more than we need to. I mean, there might be months where we miss the month and where we need to make it up the next month. I mean, we're only 1 month in. But I think generally, given, we're running it, it's a rules-based process with the active overlay, in terms of the options as well. It's data-driven. So we have a spreadsheet. We know exactly what we need to hit to make our number. And that number is, we chew it up throughout the month, to plan to make sure that we're making that 1.25%. So it's not an overly aggressive goal to hit that 125. So, we'll see how it plays. But, particularly in this market, I mean, what a market we've had in its first 4 weeks of trading. Tremendous volatility on the upside and the downside. So we've kind of seen everything so far. So I was pretty pleased with, how we were able to manage that process.
Is that 1.25%? Is that a fixed rate? Like that's it? You're going to pay it out regardless,
That's our goal. That's our goal per
but it's
month.
not fixed.
Well, we can't fix it because then we'll disappoint, right? So God forbid something happens where we miss it. Then we'll have to make it up the next month. But our goal is 15% per year,
Yep.
and we break that into monthly. So the goal is the 15%, but the sub goal is let's spread it evenly over the year, 1.25% per month.
Mhm. And if you guys end up generating excess amount of cash, you're just going to distribute that out at the end of the year, sort of thing, last 2 weeks of the year.
Yeah, I mean, that would be what, yeah, or yeah, we would probably spread that. Again, I don't want to say that we will beat the 15%. So I think we would probably use excess cash to just make the next month's number,
Okay.
make it a little easier, which then would probably increase the upside capture for that month. So as well. So there's no free lunch, right? It all kind of mixes together, but we're not looking to beat the 15% or miss it.
I just know that some, other funds will go, we're just going to pay you 95 cents regardless. We'll take it out of the NAV if we have to. So I didn't know if you were going to have kind of like we'll do our best approach.
Well, yeah. Well, again, though, the product is predicated on that 15% annual, which is the 1.25. That is our stated goal. So I keep saying what's not our stated goal. Our stated goal is that 1.25. And that is what I'm, going to stand up and bang the table and say, this is what we need to achieve every month. So I'm hoping we don't miss that ever. We'll see in a couple of years if it's ever happened. But I don't see it. I mean, given the nature of the underlying, the operational processes we have in place, I can't imagine, it's going to be a frequent occurrence to miss that number.
Do you have anything coming up in the REITs sector?
We don't have REIT income play, but we have four additional income products that have been approved that we'll be, we'll start bringing out once Omaha gets, gets, and I call it Omaha, OMAH without the A at the end.
Yeah.
Um, we have factor products. So I don't know if you're familiar with factor investing. So low
Uh,
volatility, momentum, value, quality. So some of the bigger, more successful kind of regular index funds out there. So if you look at like iShares and stuff like that, they have these factor products, and what they're used for is core equity exposure, but to tilt your equity exposure for different market environments. So like right now, I wish we had our low volatility product out. That would be quite a play right now. So basically, we just take an equity portfolio. We have different fundamental screens that we use to identify the right portfolio to give it a different tilt, a low volatility tilt or a high momentum tilt or value tilt. And then we put our 15% overlay on top of that. So we'll be bringing those out. We have four of those on the shelf.
and how long does that take to launch?
Well, they're ready to launch, so it's just me holding it up. I'm careful, so I'd like to see Omaha take off, get some traction, and once that happens, then we know things are going well, and then we'll bring out the next one and the next one and so forth. We're
Okay.
not going to bring out 30 products at once. We're going to be very, very careful and make sure that whatever we bring out is of high quality. My whole reputation is about building high quality portfolio solutions. So I want to retain that as best I can.
From like Main Street to Wall Street or State Street, in your previous case, um, there's definitely a general dislike when fund managers start just issuing out. There's a new fund every week. People go, hey, like they're just issuing a shiny object, and they just keep collapsing.
Yep.
And it's like, what's the point?
Yeah. Well, that's the dirty little secret in the ETF market, right? There's a lot of marketing, and look, it's a fun company. I'm sure it happens across the financial services industry, but I've always railed against this. It's like throw the spaghetti against the wall approach. It's a ton of products. Let's see what sticks, and we'll go with that. I mean, that's not never been my approach. My approach is more about I believe in this product. It's well constructed. We put the research in. We believe in it, and I can get up here and talk to you and defend it. Am I right all the time? No, I'm not right. Who is? Nobody's right all the time. But I think the products we bring out are going to mean something, and they have specific use cases. They're not like, oh, bring this out and see what happens. Omaha, for instance, has very distinct use cases, and they're use cases that don't exist currently. There's no products addressing them, in my opinion. So that's why we bring it out. And the factor products are similar. There's nothing in the market like it. So if you like factor investing, which $200 billion says people do, because that's how much are in these factor products, why not bring it out with some income overlay? And that's how we kind of think things through.
And these are all going to be, and you said there's what, 4 or 5 people in your team, and you're going to actively manage all these.
So again, we work with title. So
Okay.
we have, so just to give you our structure a little bit. So it's my team at VistaShares, which we keep hiring people. We have a handful now. But then we work with John McNeil's companies. John McNeil is my partner I mentioned to you. He has a company called DVX Ventures. So we use all their infrastructure for our back office. So all of our finance and HR and all that good stuff that I don't want to deal with. They do that. And then Title does all the fund stuff. So fund administration, they're our outsourced CCO. We use their trading desk. So they do all the plumbing work on the back end. So, they've got their, 100 people. We're not using all 100 clearly, but, we've got 5 or 6 people dedicated to us on the trading desk that are, experienced in trading options strategies and been doing it for a long, long time. Title has 10 or 12 billion in option strategies currently.
So your primary job is really the research part of this, the meat and potatoes.
Research and then manage. I've been in the ETF market a long time, so I'm pretty experienced. So I oversee all the stuff that is happening. So even though Title's running it, I'm integrally involved with all the operations and to make sure it meets everything we're looking to do. But yeah, the research, the product design, the sales and marketing, and the overall operations management. So we don't just outsource it and say, all right, have fun, guys. You know, I'm a little bit of a OCD guy. I like to keep my hands into everything. Make sure, look, it's my brand, my personal brand, and we're building a company, so we got to make sure that things are working the way they need to work in every aspect of the business.
Of course. I had a question from someone had wrote in and asked me this question. How does Vista approach emerging markets and international exposure?
Huh. Well, we don't with Berkshire Hathaway unless it's in the top 20 holdings.
But
So we're not going to be expanding behind that. We'll leave it to Warren Buffett to choose his top 20 holdings. I don't think I can improve upon that. So, but in terms of international, there's a big opportunity there. I think on the income side, there are some products out there, but I think as with anything, they could be improved. So, it's something we'll be looking at for sure. As we move forward, and we've seen a nice pop in international and emerging markets, to the detriment of the U.S. market recently. But who knows how that plays out going forward.
any interest in Larry Fink just secured that deal with the Panama Canal and 44 other ports
Yeah.
globally. Any interest there for VistaShares?
Well, in terms of like a port international trade product, I mean,
No, just BlackRock's. You guys are doing Berkshire. Why not BlackRock? Why not State Street?
yeah, I mean, you could really go down the list. I mean, there's other, top investors that actually you can do that with. It's not on the radar right now for us to do, but it's certainly something. There's so many good ideas. That's always the challenge, right? I mean, you and I could just brainstorm 10 ideas and we'll be like, those are the best ideas ever. And they probably are, but for us, to your point about throwing a bunch of, products against the wall, we're going to be very methodical. So, we've picked our spots, and we're going to, bring those out and make sure they're successful. And, on the artificial intelligence side, it's the same thing. So, if you think about our families, we have our growth equity products, which is AIS is our first one. Electrification will be our next one, most likely. But there'll be others, robotics and things like that we're going to apply this bill of materials investment process to. So that's one family. And this next family is our income family. So we're going to go deep into this family and bring out products that hopefully mean something to investors here.
I feel like this is always changing. Like the rules of money are always changing. We had Act 40 that said that you couldn't have like more than 25%, right, of the ETF holding the underlier. So people went, we're gonna pick up treasuries and write call options on just to gain the 100% exposure. A lot of people don't know what that is, but that's okay. Where do you see? And then Direction came up with 4x leverage. Where is this environment going? Like we're always evolving. 10% is like people go like, I don't even want 10%. I want 15. Like 15 seems to be like the new standard. Where do we go from here?
On the income side?
No, just is like the money is evolving. It's like the compounding nature of everything is like to infinity.
Yeah.
Like where do you go?
I mean, well, I think there's two things that are happening, right? I mean, one is the kind of evolution of innovation on the fund side, and how do you, cram in different types of strategies within the rules, the SEC rules, right? The 40 Act rules. So, and those, people are very smart and they keep coming up with new things that you can do. I mean, look, in my index IQ days, we couldn't even bring out a product like OMAH. All these income products are, what have they been around for 2 or 3 years at this point? And that's because there was a different reading of some of the rules, the fund rules, the 40 Act rules that allowed some more flexibility in portfolio construction within an active ETF. So that brought in all this new innovation that's been happening. So I think that will continue. People are always coming up with new, interesting ways to, create new strategies. And look at Index IQ when I did hedge fund replication, that had never been done before. How do you put a hedge fund strategy in an ETF? We figured it out. It was brand new. So, there'll be that innovation. Then the other part of it is the kind of the investors that are, gravitating towards these strategies. It's a whole new world right now. I mean, even talking to you, which is amazing for me. I love these types of conversations, and these did not happen in 2006.
Yeah.
Distribution of investment products is all about having a sales force, knocking on doors, going to talk to a Merrill Lynch advisor and stuff like that. Now it's really more about going right to the investors and having conversations and real conversations where they can challenge me, which I love, and and they're looking for different types of products, right? Today's investors, I think, are much more savvy than they were 10 years ago. I mean,
I
10
agree.
years ago, it was a 60-40, portfolio. Now it's income strategy. It's its use of leverage. It's all these things that, frankly, I'm shocked that a lot of these investors, they really understand it and they get it and they know how to use it and they understand the portfolios. Very sophisticated, very different world.
I don't hear anyone talk about mutual funds anymore. And I think it's something I want to ask your opinion on. We got $80 trillion roughly coming down from boomers that are going to be passed on to millennials and
Yep.
Gen X, who are just like, they spend all their time on these silly things and on their Robinhood apps, which I love. And they're going, I'm not working. Like, they screwed my parents with their pension. They got rid of that, introduced the 401k. So they went from working 20 years to 40 years to get
Yep.
the same stupid benefits. And I'm not doing it. Like,
Yeah.
people, they don't want kids, don't want to get married. They want to retire at 35 and have income coming in and just, travel the world. They want to
Yeah.
go to Bali.
Live their life. Yeah.
How do you, as a fund manager though, how do you capture that?
It's hilarious that you just mentioned that. I literally did a deck yesterday or with my team about exactly what you were saying about the $80 trillion that is coming from the boomers and being distributed to what we were calling, like, I forget, the digital generation or some stupid name we used. And their behavior has completely changed. Their use of apps, the amount of times they check their portfolios in a day versus,
Quick. It's
I mean, boom, boom, everyone's on it. And how do you capture it? You got to have, I think you got to be smarter about product construction. You can't trick them into saying this is a good product because of, I say it is. They know it, they see it. So, like when I was talking about AIS, you're getting Mag 7 with the competitors, or you can get the picks and shovels. I think, today's investors get that. They say, wait, I don't need that. I have this in my portfolio, the Mag 7. But so how do you capture? I think it's through intelligent design. And I think it's, communicating directly with them and, having real conversations and, answering the questions as truthfully as possible, with complete truth. And if you don't know something, just say it. I mean, that's, I hate not knowing something, but to your point, it's like, I don't know a lot of stuff, but I know what I know.
Mhm.
And I'm always willing to go back and get a question answered and come back and report back. But it's about being real. I think now you gotta really talk to people, and just be real and a nice person.
it's boots on the ground, but in the digital age, right?
Yeah, yeah. I mean, I love these conversations. I'll do these all day long, and um, it's people are smart. They really are. And, these 25-year-olds, I mean, I look on X and I'm looking at what they're talking about. I'm like, wow, that is a sophisticated conversation they're having on X in, 20, 30 words. And I'm like, that is a really smart insight.
Yeah.
And, that didn't happen 10 years ago.
Yeah, I know if I were to ask my parents, they would just think I'm like, this is voodoo magic. They don't know what I'm talking about. Compound interest doesn't exist. It's not a thing.
Right. Exactly.
They've never heard of it.
Yeah. So I think you need to have products out there that help the new generation of investors achieve those goals. They want passive income, they want growth, come out the right combination of products that, can fit, kind of achieve their goals. And that's what we're trying to do, because our distribution model is being designed around, this new generation of investors. I have a couple of salespeople that are going to go out and do what they normally do. but we're looking to speak right to the investors. And we're brand new, so we're small. We got a long way to go, but I'm hoping that people will like what we say and give us a shot.
I'm going to give you because a lot of people are going to see this. I am going to give you the golden nugget of nuggets that you will probably never hear ever again.
All right. Should
Are
I
you
write
ready
it
for this?
down? I got my pen.
Okay. So most of these funds, right, that the millennials like myself or Gen Z are buying are the income funds. Most of them are using Robinhood. The problem with now, as you know, like the transfer agent distributes out all of the dividends equally, proportionally at the same time.
Yep.
Schwab pays first thing in the morning before market opens. Robinhood, which all of these other people are using, pays after market closes on Friday. So when they're reinvesting, it's Monday morning and they get killed in the aftermarket. Okay. So when I had Howard Chan on here 2 months ago or a month ago, I convinced him to go, let's do X dividend day on Wednesday. So people on Robinhood get paid Thursday night so they can trade Friday morning. And now everyone's going, well, can I get something on Tuesday? Because a lot of people are getting their dividends on Monday from like Round Hill, Defiance, Yield Max. They're getting them because they get paid out Friday after market. They're actually getting paid Monday morning. That make sense, right?
Yes, that's
So a
interesting.
lot of people are going, I need something to fill Tuesday and Wednesday's gap. Can Omaha fill that gap?
So have a pay date on a Tuesday or a Wednesday.
Correct. Because no one else has that.
I'm writing that down. That is interesting.
Robinhood I think Robinhood screws investors because they're making that, because a lot of investors don't know this, but you know this, right? Because as the funds come in, they're just kind of sitting on them and they get to make the market. They get to make the percentage points in between as it goes up. Whereas
Yeah.
like the old school investors who have Schwab or had TD Ameritrade or whatever get it first thing in the morning, and they have a natural rise up as everyone else is reinvesting, as they're getting their dividends throughout the day or at night. They're getting that reinvestment, so it's like compounding naturally by the reinvestment of everyone else in Robinhood. So Robinhood users get screwed. So just to try to way to capture that, that Gen Z, millennial audience that you're trying to do, give them a Tuesday or Wednesday. That way they can have the rest of the week to enjoy, because they're not going to get paid out until the next following day.
That's brilliant. So you have your declaration day, kind of the end of the week prior. X date would be Monday, and then pay date on Wednesday.
Yeah.
Or something like that.
Yeah, I think you'll be able to catch, because no one else has it. Like I said, I got Howard Chan to do, even though they have, and that's Curve, they have the single ticker ETFs, and they do, one payday a month, just like you guys, but he's staggering it so that it pays each month, but on a different week. So like his Tesla one will pay 1 week, Amazon will pay the next. So people are getting, and I think that's what I'm trying to convey here, is that in this new era, people aren't going, you know what, I want to buy, I don't know, Visa, I don't know if it pays a dividend or not because I don't own it. It doesn't pay a dividend. It's not paying. I can't buy Visa and replace my income, right? These people are going, I'm jumping from job to job, and I want the money now. I'm not waiting until I'm 70 years old and I'm dead and I can't enjoy my life. We want the money now. How do we get paid? Either every day, every week? You know what I mean? So just a little nugget.
That's brilliant,
A
man.
little different.
I'm going to look into that. I'm going to report back to you on that.
Okay.
That's awesome. Thank you for that.
Like I said, no one else will tell you that.
Yeah, that's great. I'll check our dates now, but I'm sure to your point, I'm sure they're all set up for a Friday pay date. So let me look into that.
Okay.
I don't know that. Yeah. Interesting. Okay.
I know Curve's going to be on a Thursday pay date, right? So now but if people getting paid, like Schwab and Fidelity gets paid on Friday, right? Probably from Omaha, right? Robinhood users, which a lot of people are using, right, are getting actually paid on Monday, so they get screwed. So how do you fill that gap, that Tuesday, Wednesday gap, to where people are going, I'm getting paid every day, every other day? VistaShares has a huge market opportunity there to capture that because no one has it.
Is there a preference between Tuesday and Wednesday, or either one is a
I
good one?
think I think either one. But if you have multiple products coming out, you could stagger them. I know
Yep.
it's more compliance work and it's a pain in the ass. I get it. But there's an opportunity there for you guys to capture.
That's brilliant, man. That's brilliant. Thank you for that. Yeah. All right. I'll let you know. As soon as we get off, I'm going to look at our distribution schedule and see what I can do.
Um, and I got some more questions for you.
All right.
For roughly 4 trillion has been removed from the the economy. Uh, any do you think we have more downside to go? Based on what Jerome's saying?
Yeah. I mean, well, how's the market doing today? Because today was interesting. Yeah, we're getting, well, no, it's,
Today's tariff day, today's Trump
yeah,
tariff
no,
day.
it's recovered. I mean, we're almost flat. Um, yeah, I think we're going to see more volatility before we see the upside kick back in. It's just my sense. I just think there's a lot of factors now. There's economic factors, there's geopolitical factors. There's a lot going on right now, and if anything, now you hear what's going on with Iran, and you got the Middle East war, you got Ukraine, you got a lot of stuff going on that if anything's triggered, we're going to see a pretty significant drawdown, I believe. But I think the overall trajectory of the market will continue to go higher over time. I think the administration now understands the market. They want the market to, go up. They don't want it to be volatile like this. But I think that what they're trying to do is pull the Band-Aid off, whether you agree with it or not, and make the changes they're looking to change, which they believe are positive. But I just think there's a lot going on right now. And over the next few months, hopefully we'll see things settle down into the summer, and hopefully see the market get a little calmer in the fall. Is my hope.
Yep. Yeah, I keep saying that we're going to chop to. I keep calling. I call it a box between 4,800 to 5,100. I think is where we kind of chop downwards, and then we start capitulating, and then it's off to the races. That's my guesstimate. I don't. Do you have a guess where it could be?
I don't. That's where I would be wrong. Yeah, no matter what I say, I'm going to be wrong. So, I just kind of look at the kind of broad macro trends, and I just view it as a little, we're facing some more volatility for sure. But look, if you look at today's prices, where are we now at September's levels, or somewhere around there, September, October?
Yeah, we took off 6 months gains. Sure,
Yeah. So, I mean, it's not the end of the world. It's.
it never is.
Yeah, exactly. It always comes back over time. So, dollar cost average, right? Just keep
That's it.
investing your dividends and keep buying more.
As long as it eventually goes back up. Dollar
Yeah.
cost averaging to the downside, it's a mathematical fallacy. You cannot dollar cost average to the downside
Well,
because
if it
you
keeps
end
going
up
down.
for every 1 percentage point, you got to divide by the amount of your percentage by 2. That's what you'd have to reinvest to capture the actual dollar
Yep.
cost.
No, absolutely. It's got to come back up for
Yeah, it
sure.
has to come back
Yeah,
up. Like
yeah,
otherwise, it doesn't work.
yeah,
People
absolutely.
go, people with these, the high income yield, these funds, and they're going, well, I'm getting 5% a month, and I keep reinvesting, aren't I? Dollar, I'm like, you are, but you're never capturing the bottom. Like
Right.
you're never going to recapture that,
Yeah.
and they just haven't done like the math to actually see like how far down they're going.
Well, that's very true. And unfortunately, we just never know where the bottom really is. So, that's always the tricky part.
Yeah, I mean, this is a growth play, so it's steady income growth. We like
Yeah.
that.
Yeah, absolutely.
Any family offices that are you guys involved in?
In terms of having them as investors.
Yeah.
Yeah, I mean, we have.
Where do institutions come in?
Well, we're just starting the process to sell Omaha into the market this week because we were waiting for our first income print. So
What?
before we started, so yeah, we've had several RIAs already start investing, and typically the way they work. So our distribution model from a salesperson perspective will be RIAs. So the independent registered investment advisors and family offices, some of them are very similar in how they operate. Typically they'll come in, they'll make their test trade of, 10 or 20,000 shares. They'll watch it for a couple months, then they'll come in with their big allocation. So, we're seeing those test trades already coming in. I mean, the volume has been really strong. I mean, for a product that we haven't even, oh, yeah, I mean, today we're almost at 30,000 shares. And again, we haven't even started selling this thing yet. I mean,
Yeah.
our marketing just started yesterday. So,
Yeah.
you know, I think, but I think it's mostly retail, people who are recognizing the value of it and starting to come in. But we're starting to see those small RIA trades coming in already. So when you look at the trades, you'll see, 40 trades of 100 to 400 shares come in the same second. It's an RIA, allocating across their customer accounts. So we're seeing that now. That'll accelerate over the next few months, and that'll take the product to the next level for sure.
Um, Mike, our mutual friend, asks, when is EVS being released? He wants to know if you two are best friends now. You were listed in the newsletter, so was I. So I'm gonna put it in the I'll put it in the description box below. But yeah, he wants to know when EVS is being released.
Yeah, oh, he's the best. He's the best. I got to get in touch with him and see if he'll do a interview with me like he did with Defiance. But he's a great guy. So EVS is approved and it's ready to go. And I think once we get a little more traction with AIS, then we'll bring out EVS. So
What is EVS?
I'm sorry. EVS is the electrification
Okay.
product that we discussed very briefly earlier, which is going to capture all that, the energy components of, developing the energy infrastructure, the power grids, the energy storage solutions, all that stuff that needs to happen to power everything that's happening on the AI side and the electric vehicle side.
So is this going to be like all commodities across the board?
Well, no commodities. Again, it's going to be all supply
Sorry.
chain infrastructure, just like AIS. So it's
Okay,
going to
I
be
was thinking that, like, you were going to buy like electricity companies and
We'll be buying the companies that develop the power grids, that develop the storage solutions.
okay,
All those again, same process that as AIS. It'll be the supply chain of
the
all the
distribution.
companies
Yeah. Yep.
building that infrastructure for the energy, the nuclear, the solar, the coal, whatever it may be. But all the companies that are going to building those facilities out.
But I just want to make that clear for anyone who's watching. It's not, you're not buying limited partnerships
No,
that are mining for coal. It's
no.
the companies that are maintaining the power lines outside of your house that actually bring the electricity in, not the ones that generate it.
Right, bringing or building the new infrastructure required to bring that energy in
Sure.
more so than the old school utilities. I don't know that we would have utilities in there or old school utilities. I think it's more about what are the 20 companies that are building all the charging station infrastructure around the world, and what pieces go into that. And I'm just using that as an example, but
So would Tesla be a part of that?
Tesla would not be because they would be end consumer. We'll have the ability to bring end consumer companies in, but similar on AIS where we don't have Google and Meta, the end consumer companies, we wouldn't necessarily have the end consumer companies on the electrification side either. We would have all the companies that are going into building the Tesla, for instance.
I meant like because they have the charging station. I didn't know if that was kind of in the same realm.
Yeah, I don't know if it's a big enough part of their business that they would be part of that supply chain. But I'll have to look at that analysis to make sure. But my guess is they probably would not be.
Any interest in cobalt for lithium batteries? It's like the main ingredient. Everyone needs it.
I mean, it sounds really exciting. I wish I knew about it. I'm not I'm not familiar with that. I don't know. I don't know where that would fit in the supply chain, but if it fit in, it would go into the product. But again, I'm not an expert in that.
That's okay. Um, Chris on X asked, is it the intention of the ETF to follow the movement of BERK, Berkshire?
It won't follow it exactly at all. And in fact, I look at it daily and I'm like, wait a minute, that Burke is up 0.5, we're up this, or we're down. Or so you remember Berkshire Hathaway. So Berkshire Hathaway, BRKB is our top holding, and then we have the top 20 holdings of Berkshire Hathaway. Berkshire Hathaway holds a lot of companies. So we don't have the whole tail of their portfolio in the product. We have their top 20 holdings
Yeah.
plus Berk B. So over time, we're looking at probably 70 to 75% of the upside with probably 85, 90% of the downside. That's kind of the general parameters we're looking at from a portfolio construction perspective, but it's not going to track exactly, particularly when Berk is on a tear. So when Berkshire Hathaway is going straight up, we're not going to keep pace. I mean, because we're not getting the full upside capture. We'll perform hopefully better than Berk B when it's flat to down, and we should do a little bit better with the income overlay in there, providing that kind of the ballast for the portfolio.
Berkshire is also interesting because they have, which a lot of people don't understand, they kind of they have a nice float, right? Like they have the insurance companies paying that monthly premium, sorry, and people that are insured through whether it's Geico or their car, whatever it is, they kind of push that float process up.
Yeah, they're getting monthly dividends from, I mean, where they're getting the payouts from the insurance companies. I read something on X from a really smart guy who he was breaking down Coca-Cola's dividend. He got a $200 million payment. So yeah, they've got a tremendous amount of cash flow coming into that portfolio. They've also got a lot of cash on the balance sheet as well. But yeah, so we're not holding, I don't know how many companies are in their portfolio, but it's a lot more than 20. So we're not covering all that other portion, but we're getting the majority of their portfolio in
And that
terms of.
top 20 makes up how much of their
That's a great question. And actually, I was just thinking that, and off the top of my head, I don't recall the exact number, so I don't want to throw it out there, but it's a significant piece. I don't know if it's 40%, around 40%-ish, I believe. But I could be a little off, so I don't want to overstate that. I can.
I think it's like the Mag 7 makes up, it's like 30% of the entire S&P market cap, which is like, it's wild.
It's out of control. It's scary to be honest with you, but so yeah.
This is a new fund, right? Interest rates are theoretically we're gonna start seeing them come down. Are you guys are you gonna try to capture that? A lot of people don't understand this. When small caps suffer greatly, it's because they don't have that extra cash revenue just sitting on the sidelines. So when interest rates come down, they borrow at low interest rates, prices kind of go up. Will that impact you guys at all?
I mean, the top 20 holdings are generally the larger companies, right, in the Berkshire portfolio. So we're not going to have any kind of small cap phenomenon in this portfolio. I don't know what the smallest companies in the top 20 are, maybe a VeriSign or something like that. But there's no small cap exposure in the OMAH portfolio.
I meant for your company specifically. You're going to try to take on some low interest debt and try to push the price up.
Oh,
to try to reinvest.
Oh, in the product itself,
Yeah.
you're saying?
Yeah.
No. That's not part of the investment strategy.
Okay.
It's very simple. We keep it very rules based, with the active management overlay, but we're not doing anything fancy like that. It's Berkshire B, top 20 holdings, rebalance quarterly. We
Yeah.
rebalance that quarterly for movements, and then with the active overlay for the income.
Okay. Does VistaShares have any interest in gold? It's up 17.52% year to date.
Oh yeah, it's had quite a run, right? I mean, my God, that's an interesting phenomenon for sure. No, I mean, we're not going to bring out a gold product. Those are well covered, and it wouldn't be something that we would be adding to this portfolio because it's not part of the investment strategy.
Okay. Bob asks, do they plan to offer any other ETF index-based covered call focused? Can they share the methodology for holding, selection, distribution?
Yeah, so I don't want to get into all the details of the methodology right now because it'll take us an hour, but those factor products we mentioned. So we will have the 4 factor products that are on the shelf. We're not going to bring them all out at once. Maybe the low volatility one is the first one. And so it's low vol is one. We have momentum, we have value, and we have quality. And those will be run on multi-factor fundamental models, the very, typical models to provide that factor exposure or the factor tilt, I should say. So we're with the low volatility model, we're looking for companies that experience low volatility. Historically and on a forward-looking basis, there'll be 25 to 50 companies, equities in each portfolio. And we'll have that 15% overlay on top of that. So we think these are going to be really exciting products when we bring them out.
What would be an example of a company that doesn't have that has low volatility?
Off the top of my head, I don't know, but maybe probably something, maybe an insurance company could have low volatility. We'd have to look into but it changes. It changes. So you got to have the fundamental model that rebalances. I think we rebalance monthly for these, so it'll be really making sure we identify those companies that are most appropriate for the factor every month. I mean, look, for the last few years, the most important factor exposure was momentum. Everyone wanted momentum exposure because the market was just on a momentum tear.
Yep.
That is over now. And now low volatility and quality and value, frankly, all three of them are starting to kind of become more important. And, we'll see how that plays out.
I just had a I was just sorry. I was just looking at a chart from, I think it was 1950. The market has returned, it's like 70% green. You know what I mean? Year over year, it's had huge dips, right? But also had a massive return, ended up green. Does VistaShare, or do VistaShares, do you guys wait for a deep in the red day? You're looking for Berkshire to track, 1% down before you buy, you capture some of that, knowing that it's going to go up, but you'll be able to capture that dip. Are you actively managing that?
In terms of the options or in terms of
Yeah, do you guys look for, any deep, any deep red days? Or are you just going, as money comes in, we just allocate
well,
it and that's it?
well, no, I mean, yeah, I mean, there is a rules-based process or a data-driven process to say when the optimal time to sell the calls are. I can't speak to what the parameters are on, 1% down, 50 basis points down, or whatever it may be. But certainly the team is managing the portfolio daily to reach our income numbers as cheaply as possible and as efficiently as possible. So in those down days, when there's volatility, that's what you want, right? You want some volatility to sell those calls. So my guess is that, in fact, I'll give you just a quick example. I'm not going to be able to. About 2 weeks ago, there was some big drawdown days. I forget what they were, exactly when it was, but 2 weeks after we launched the product, there was some big drawdowns, and the team made up the whole month basically of income, basically in that 1 or 2 days. They were able to bank enough during that volatility.
So what do you do with the excess?
The excess that's made throughout the
Yeah,
month.
you're collecting excess premium. What do you do with it?
Well, if there is excess premium, if not, we're not deploying the option strategy so that you can capture more of the upside on the portfolio.
Okay, so that'll just get added back into the growth.
Yeah, sure, of course.
Okay.
So we're not going to distribute excess. We're going to hit our number or do our best to hit a number.
Okay, I like that. Is there anything else you want to share with us today?
No, this was a lot of fun. I mean, I love to thank you for your insight on the pay date. I'm gonna have to look at that and I can let you know how that goes. But I just thank you for having me on. This is fun. This is fun. Another Massachusetts guy. So that's beautiful.
There's a lot of them. I'm gonna try to get together because there is such a there's a lot of people in Massachusetts. I don't know what it is. I don't know if it's like because it's the highest that's you probably have the, maybe not, highest disposable income in the country because it does cost so much to live here. So you have you have so much money in Boston, right? And people go, their intuitive nature is, I have to invest. It's that old money like philosophy. Money makes money. It's very tight knit communities. I don't know if that's what it is. I'm going to try to get together. I think there's like 10 people right now of just everyday folks that are investors, and I want to try to get together maybe in either Boston or Newport, maybe this summer, and just try to like chalk it up and just see what everyone's interested in.
That's awesome. Yeah, that's very cool. Yeah,
I know they just had the ETF convention in Las Vegas that a lot of people went to. Did you go to that?
I didn't go this time. I go all the time. I didn't go this time because they're great. They're fun. I'm
And
more
they've done that.
Yeah, well, I mean, eventually we're going to have to go again, but it's a lot of schmoozing and it's fun. But in terms of talking to investors, in my experience, it's just not as effective. It's, it's great to see your friends and have drinks and stuff like that, but good networking. But, yeah, at some point you have to have a booth there just because you have to be there, but not this year.
Are you going to Miami? I know that there's I think it's in the spring. It should be coming up here. I think it's in May. There's usually an event twice a year in Miami. A friend of mine hosts it, and she basically gets all the family offices and whatnot together,
Oh,
and all
wow.
the institutional investors, and it's kind of like it's the nonprofit for-profit thing, and they got to allocate so much capital.
Oh, interesting. Yeah, I don't know that one. No, I
But
mean, it's interesting.
I'll have to find out the date, and I'll private message you. And if it's on your radar, if you're like, hey, I need some sunshine. I'm gonna get out of get out of the Northeast.
I could definitely use sunshine. I mean, look at my complexion. I'm like, I'm white as a ghost. And then with my background, I look even pinker. So I could use a tan.
I get it. Like I specifically didn't turn on the light. This is just natural. This is natural sunlight. There's a window right here.
Perfect.
Otherwise I'd disappear. It'd just like cast, I'd just melt into the wall.
Oh, God. It's brutal. Yeah, well, Northeast, it's wonderful. At least it's not raining or snowing today. So I'll take that.
Yes. Adam, thank you so much for coming on. And let's do this again. When we let me know, or I'll we'll keep in touch when you plan to launch those other funds, and we'll 6 months from now, whatever, we'll see where you're at. See how the fund's doing.
That'll be awesome. I appreciate your support and taking the time to talk to me.
All right, Adam. It was a pleasure. Thank you so much. And I will
Thank
see you next time.
All right, definitely.
All
Thank
right.
you.
Take care.
Take care.